Okay, so in this video, we will be discussing SSS, specifically their financial statements. We have here the 2019 financial statements, and then the third quarter for 2020. I'm not sure if they already released the unaudited 2020 financial statements, from January to December 31. But anyway, what I got here is the third quarter for 2020. And then I also have the annual report for their 2018 fiscal year. Anyway, calendar year. Okay, so to start, I have here the audited financial statements for 2019 issued September 30, 2020. So this is a letter from the Commission on Audit, which is the official auditor of government owned and controlled corporations. So SSS being one. Okay, let's just read. Pursuant to Section 2, Article 9Z of the Philippine Constitution and Section 43 of the Presidential Decree Number 1445, otherwise known as the Government Accounting Code of the Philippines, we transmit herewith a report on the results of the audit of the accounts and transactions of the Social Security System for the years ended December 31, 2019 and 2018. So it's a comparative financial statement, so you have your current year and the previous year. The report consists of the independent auditor's report, the audited financial statements, the observations and recommendations, and the status of the implementation of prior year's audit recommendations. Okay, so they do what they call this. They do check if the recommendations from a previous year has been applied or has been implemented, or they haven't done anything. So in each case, it would be recommended again for the current year. So the auditor expressed a qualified opinion on the fairness of the presentation of the financial statements of SSS as at December 31, 2019 and 2018 because of misstatements briefly discussed below that exceed the materiality level for said year. Okay. Basically, if a financial statement is very clean, there's no error, or it has complied with accounting standards, so the type of opinion that is being issued is unqualified opinion. But when an auditor issues a qualified opinion, that means there are certain items or certain transactions that are not really questionable but somehow do not comply with accounting standards. Okay, but in a way, the presentation is still there, but there's some misstatements, but it could be corrected, and it's not exactly fraudulent in a way because it has been seen by the auditor. The documents are there. It's just as maybe in the recording, it has not been properly documented, or it has not complied with the accounting standards. All right, so for the qualified opinion, normally they provide which items have caused the qualified opinion. So for this one, they have this. Philippine Accounting Standards 40 requires that the entity shall apply the chosen accounting policy to all of its investment properties. In the case of SSS, its chosen accounting policy is the fair value model for the measurement of its investment properties after recognition. Okay, so fair value model. However, some of its investment properties, namely following properties, measured using the cost model. Okay, so for this one, the misstatement is caused by they're supposed to use the fair value model, but presentation-wise, the amount presented is only the cost of the investment property. So they have here additional information. The balance of the fair value gain investment property land account is likewise understated by 4.7 billion in calendar year 2019. Okay, so maybe if they restated it to their fair value, so there's an additional asset valuation amounting to 4.7 billion. Secondly, the account balances of the loans and receivables of 101 billion in 2019 and 95 billion in 2018, investments in debt securities at amortized cost of 220 billion. Yeah, we have a dog. Sorry. At fair value through other comprehensive income. Okay, these items are misstated by undetermined amounts due to the non-adoption of the provisions of the Philippine Financial Reporting Standard 9 on the recognition and measurement of expected credit losses through a loss allowance. Okay, so these are receivables and investment accounts. These are assets, okay? And then what they did is that there's a misstatement of undetermined amount, so they don't know how much is the misstatement due to the non-adoption of the provisions of PFRS 9. So this is an accounting standard for the what do you call this? Recognition and measurement of expected credit losses through a loss allowance. So we can say that they did not maybe provide enough allowance for these assets, these receivables and investments. Okay, so most likely it's these accounts are overstated, or if they already have the loss allowance, maybe it could be higher or it could be lower, depending on if they did apply the provisions in PFRS 9. Okay, we recommended that management require on the valuation of investment properties, the investments accounting department, to properly effect appropriate accounting entries to reflect the proper valuation of the properties mentioned in accordance with International Accounting Standard 40. Okay, they used IAS because essentially the Philippine accounting standards are copied from the International Accounting Standard. Okay. On the non-adoption of the expected loss model under PFRS 9, a policy guideline adopting the requirements of PFRS 9 on the recognition and measurement of impairment on financial assets be recommended by the Project Committee for the implementation of PFRS 9 for approval by senior management and the Social Security Commission. The SSS departments handling the loans and debt securities compute the impairment provisions based on the policy guidelines that will be approved, recognize in the books the impairment provisions, and the concerned departments disclose in the notes to financial statements information on the adoption of PFRS 9. Okay, so basically they're saying to use the provisions of the respective accounting standards. Other significant audit observations and recommendations that need immediate action are as follows. The balance of cash and cash equivalent cannot be relied upon because appropriate accounting entries are not taken up to effect adjustments for outstanding checks, sale checks, and other reconciling items amounting to 1.6 billion. What? Wait, what? 38.18 million and 1.4 billion in that order. Wait. So for cash and cash, this is for the account of cash and cash equivalents, and then we have outstanding checks amounting to 1.6 billion. So these are either payments of benefits that have not yet been encashed by the people who receive them, or it's also possible that this wait. Okay, so when we say outstanding checks, these are checks that have been issued to the payee. Okay, and then we have sale checks amounting to 38 million. So sale checks should be encashed within 6 months. So if it hasn't been in cash within that period, so it would become stale. Although there are certain checks which provide that they expire or they become stale within 3 months. Okay, I think when they issue SSS loan proceeds, they should be in cash within 90 days or 3 months. Okay, but the normal number of months for a check to be considered stale is actually 6 months. Okay, and then we have other reconciling items, 1.4 billion, which have not been considered when at getting the balance of the cash and cash equivalent. Okay, so in that regard, we can say that the cash equivalent is probably lower than the amount presented in the financial statements, because we have checks amounting to 1.6 billion, 38 million, and then other reconciling items. These other reconciling items, we don't know if these are deductions or additions, but for these two, we know that these are deductions. All right. We recommended that management require the General Accounting Department, Branch Accounting Department, and Collection Data Processing and Reconciliation Department to cancel outstanding checks that are beyond the validity period, so they're going to be stale checks, and to record related accounting entries in the financial accounting systems. Okay, so if those checks are payables, then they should cancel the entry. So they return the balance to the cash and cash equivalent, and then they recognize again the liability, corresponding liability, be it benefit payable or payment to suppliers. Okay. Not later than the 18th of the following month, pursuant to SSS Office Order number 2015-057. Wait, 2015? GAD, BRAD, CDP, RD, and Treasury Division, Cash Management Department, to exert extra efforts to reconcile or adjust long outstanding dormant reconciling items to their respective maintaining banks pertaining to main bank accounts, baby cluster, and regional division bank accounts by setting target percentage of reduction of reconciling items from this date until December 31, 2020. Oh, they should have done this already. And in the succeeding year until all the calendar year 2019 reconciling items are adjusted. We'll know if they've done this, okay, in the 2020 financial statement. Okay, how much? 1.4 billion. Okay, do we know what happened to this amount of money? No, we don't know because they are yet to reconcile this, and we do hope that this have not been pocketed or something. Please, 1.4 billion. The TDCMD, what's this again? Treasury, Cash Management Department, to regularly monitor the remittances of the CBCAs in compliance with the terms and conditions of the agency agreement, to be able to immediately update the report on collections. Okay. Okay, so for this one, it's really what do you call this? If you're a reader of financial statements and you see unreconciled items, your first thought would really be, if there are fraud, has this been pocketed, why are these unrecorded? Or if these are unrecorded, why hasn't it been, recorded in their proper accounting items or the account titles? Okay. Then next you have remittances, immediately update the report on collections. Just like in GSIS, we see there, they have a certain amount of money that has not been credited to the individual accounts of, the members, because they do not know to whom those amounts pertain to, and it's a large amount of money. So it's really essential that when you pay your contributions, make sure that the SSS number is correct, your name is correct, and you hold on to the receipt or any document as proof of your contribution payment, because when the time comes and I go to the SSS, or it's not if you check whether how much contributions you've already given, then if there's a gap or if there are unrecorded payments, then you can show your proof of payment, and then they can reconcile and adjust that. Okay. And then there are also cases wherein, what do you call this? For you to monitor, I think it's really advantageous if you have access to your account online, because it's a provided service. So make sure you take advantage of that and check whether all your contributions are being credited to your account. All right. In a way, it could also help the SSS, so that if you see that there's a contribution not credited to your account, then you can go to them and ask for it to be reconciled. Okay. Accreditation Department and CDPRD to strictly enforce the agency agreement executed by and between SSS and collecting banks or collecting agents to improve collection and remittance of the agency, and to impose applicable penalty for non-compliance with the agency agreement if warranted. Okay. Member loan overpayments not yet refunded or applied to new, subsequent, existing loans or adjusted due to erroneous postings under accounts payable, salary, emergency, calamity, structured member loans account totaling to 5.1 billion, and noted variances between the negative balance of sample loan accounts in the schedule of APSECSM and the employee subsidiary ledgers totaling 18 million contrary to the conceptual framework for financial reporting, may result in the misstatement of the balances of the account and affected receivables, ML accounts. Furthermore, this will deprive the member borrowers the use of their money. Okay? So, merong mga overpayments not yet refunded or applied to the current payables of the members. So, let's say you borrowed before. A member borrowed before and then he paid, and then there's an overpayment, and then he applied for a loan again and it's been granted. The overpayment has not been, either refunded or applied to current loans. Okay, so in a way, it's not, essentially it should be for the benefit of the member because it's an overpayment. It should be returned to the member, and if it should be applied to their current loans. The rule of offsetting, since it's for their account din naman. There are variances. We recommended the management require SSS branches, processing centers, process and post promptly and correctly loan payments. MLD and concerned groups inform member borrowers of validated overpayments so that requests for refund can be filed. Okay, this is, I don't know, they do wait for the member borrowers to file for refund before they process. But if this can be seen in their system already, I think they should have a department or someone from a certain department to be dedicated in doing that, especially if there's an existing, if the borrower has an existing current loan. Okay, so they should apply the overpayment already. MLD and AID verify, reconcile, and adjust or correct variances between the schedule of AP, CE, CSM, and ESL loan balances and encoding posting errors. Okay, so there's verification, there's reconciliation and adjustment, and correction. Okay. In a way, from the perspective of the businesses, this is going to be like the person who is responsible for the encoding or posting should really do it in a careful manner, and ensuring that the information encoded or posted is correct, so that there would be no need to verify, reconcile, adjust, or correct. This is like double. It's as if, I don't know, checking. It's as if you're going to spend twice the same amount of time over the same transaction, just to check and reconcile. So it's really important that the first person who's to do it is very aware of what it's doing and is doing it promptly and correctly the first time, okay? So that there would not be errors. Anyway, I'm going to discuss that in a separate video. The set target percentage of reduction of the balance of ML overpayments. Okay, so in a way, they should start adjusting, making sure that the balance of this overpayments be reduced until it becomes zero and everything is reconciled already. Despite the condonation penalty contribution program, the assessed delinquencies of the remittance of premium contributions, including penalties, for 463,000 employers amounted to 186 billion due to lack of monitoring related to the assessment and collection of delinquencies. Okay, so they don't have monitoring and assessment of those delinquencies. Moreover, although in the implementation of the CPCP, 55,000 or 49% of the 112,000 assessed delinquent employers were able to avail of the program. Penalty income in the total amount of 3.8 billion have been foregone, which deprived the system of additional funds needed for providing social security benefits to its members or beneficiaries. Okay, I think most of the time, these employers who do default in the payment or remittance of the contributions, they do have financial difficulties as well. But of course, it's their financial obligation being employers at the time. But if it comes to a point that they've already, closed shop, they're already closed their business, then it would really be difficult for the SSS to collect those delinquencies and, not even half of those delinquents availed of the condonation program. And then, of course, since it's a condonation, they lower the penalties. They have forgiven the penalties, and that amounted to 3.8. So it's essentially a loss to what the fund should have gotten. Okay, but in a way, at least they collected the money. How much was it again? Anyway. Alright, so the purpose of the condonation program is for them to also collect from those delinquent employers and in a way provide them with a means to be able to afford the payment. Okay, because essentially the penalties are also a burden to them, especially if they're already suffering financial difficulties. We recommend that management require, through the branch operations sector and large account department, to exert more effort in the collection of delinquency and to revisit account officers' assignments to comply with the maximum number of employer accounts handled per AMS for a more systematic and efficient monitoring of delinquent employers. So basically, they do have people, we call them accounts officers, who are allowed to handle employer accounts, and then they also monitor if these employers are remitting or they not, and if they are not, then they should in a way advise the employer to pay or remit the contributions. Through the AOs to continue to pursue and properly identify employers with reported delinquency in the remittance of premium who are already closed, suspended, or unlocated. Okay, so that they could properly reflect these figures as well in their financial statements. They could properly state that of the delinquent amounts, the probability of collection is low, so they should provide loss for those things. Okay, for those probabilities. Uncollected delinquent member loan accounts totaling 63 billion. That represents 67% of the balance of ML accounts totaling 95 billion. The same being more than 50% of the balance of ML accounts hinder the use of funds for more viable and profitable investments. Okay? Since they cannot collect, or they were unable to collect this receivable, so instead of being able to lend it to other members or to put it in other investments that could have earned the fund money, so the money is tied to those places, receivables, and until now still receivables, and it's not even sure if they would be able to collect the principal. 63 billion. We recommended that management require the member loans department to monitor the enforcement of collections by branch account officers of delinquent accounts indicated in the employer delinquency report, the PCEO or her authorized officer, to set target dates for the completion or implementation of the mentioned responsibilities of the task force on loan payment and loan delinquency, and to ensure the implementation of the planned activities as stated in the management comment. Alright. Other audit observations together with the recommended courses of action which were discussed by the audit team and the concerned management officials and staff during the exit conference conducted on September 22, 2020 are discussed in detail in Part 2 of the report. In a letter of even date, we respectfully requested the President and CEO of SSS to take appropriate action on the recommendations contained in the report and to inform this Commission of the action taken thereon within 60 days from the date of receipt thereof. We acknowledge the support and cooperation that the management extended to the audit team thus facilitating the completion of the report. Alright, so this was issued September 20, 2020, if I'm not mistaken. Or was it September 30? September 30. Okay, and then they have some recommendations, and then one of them, I think, is to be implemented until December 31, 2020, which, I'm not sure if would be able to see the differences, or if the SSS would have been able to implement majority of this by December 31, 2020, in which case, we might not see significant differences in the audited FS for 2020. Oh goody, they're hammering again. Alright, so the CAWA also issued a letter to the president and CEO of the SSS, Aurora Ignacio. And then essentially it's, the same report and their recommendations. And then they also provide the independent auditor's report, the qualified opinion, and then the basis, and then their recommendations, the auditor's responsibilities. Basically, they're just statements on how they conducted their audit, okay, in accordance with the standards, in auditing standards. Report on other legal and regulatory requirements, and for the purpose of forming an opinion on the basic financial statements taken as a whole. Supplementary information presented for the purpose of filing with the Bureau of Internal Revenue and is not required part of the basic financial statement. Such supplementary information is the responsibility of the management of SSS. The supplementary information has been subjected to the auditing procedures applied in the audit of the basic financial statements. In our opinion, except for the supplementary information is fairly stated in all material respects in relation to the basic financial statements taken as a whole. Alright. Okay, so we have the statement for management responsibility. Okay, and then we have the statements of financial position. Let's see. So we have the assets, cash and cash equivalents, 2019, 22 billion. Previous year, it's around 15 billion. Financial assets, investments made, basically again, the contributions to the members, the SSS has the obligation or responsibility to invest this, and so that the fund would earn, and then the earnings would have to, cover the administrative expenses of the organization, and then of course the excess would have to be added to the fund for the members' benefit. Okay, so they have the financial assets 64 billion, other investments 400 million, receivables 5.8 billion, inventories 95 million, non-current assets held for sale 892 million, and then other non-current assets 15 million. So total current assets 93 billion. And then they have non-current assets, financial assets, so these are investments again, 314 billion. Essentially, these are investments that are long-term, all right? Receivables, 98 billion, probably long-term loans. And then we have investment property, 53 million, property, plant, and equipment, 7 billion. So these property, plant, and equipment are the ones being used for operations, and land, building, office equipment, vehicles, okay, being used by in the conduct of the business or in the management and operating of the fund. We have intangible assets, 195 million, other non-current assets, 267 million. Okay, ouch. And then total assets, 568 billion. I think this is half of GSIS. GSIS is in trillions now, right? Okay, total liabilities, financial liabilities, we have 8 billion, interagency payables, 167. Normally, this is through BAR for, tax withheld from employees and other things. And then also payable for, the contributions of their employees as well. Trust liabilities, 861 million, deferred credits and earned income, 76 million, other payables, 1 billion. Total net current liabilities, 10 billion, and then we have the non-current liabilities, financial, 765 million, and earned income, 355, provisions, probably for, these are liabilities, so what are these provisions? 1.3 billion, other payables 50 million, total non-current liabilities 2 billion, total liabilities is around 12.9 billion. Okay, I believe this is a good, good ratio. The liabilities are not much, but again, still in the billions. So equity reserve fund 581, cumulative changes in fair value of investments 31 billion, negative. Okay, I have an issue with this. 35 billion in the negative. Revaluation surplus 4 billion, members' equity is 1 billion. I'd like to know what's the difference between the reserve fund and the members' equity, because essentially all the funds of the SSS came from the members. So, you know, shouldn't it be the members' equity? Alright, so total equity 555 million, total liability equity 568 billion. Okay, and then we have the comprehensive income. Okay, this is another thing I've been having issues with. The same with GSIS. Okay, basically the contributions of the members are treated as income. Okay, even if it's not, it should be, you know, increase in capital. If it were me. Okay. Anyway, later we'll have a comparison between SSS and banks later on, so we'll be discussing that. They have 248 service and business income, but the contributions are also included here. They have the gains from the investments, 17 billion, other non-operating income, 1 billion, 1.9. So total income, 267 billion. And then they have the expenses, benefit payments, 196 billion. Personnel services, salaries and wages of all the employees, including the higher ups management, so 6.7 billion. And then we have maintenance and other operating expenses, 2 billion. Financial expenses, 308 million. Non-cash expenses, 5.3 billion. So total 211. Profit is 55 billion. And then they have OCI, gain on sale of financial assets at fair value through OCI, other comprehensive income, 796 million, positive gain on sale. And then we have changes in fair value of financial assets at fair value through OCI again, so negative 679 million. Other comprehensive income for the year, net nitong dalawa, we have 116 million. Total comprehensive income is 55 billion, 790 million. Okay. If we compare that to the previous year, they only had 2 billion in 2018. I'm not sure. Okay, I think because of this, they have an increase in the collection from 209 to 248, but then the increase in the benefit payments is only from 180 to 196, so that's 16 billion, whereas the collection is around 37 billion. All right. Next, we have changes in equity. We'll see cumulative changes in fair value of investments, revaluation surplus, reserve fund, members' equity, total. Okay, I still don't know what's the difference between the reserve fund and the members' equity. I don't believe that the members' equity is only at 773 million. Okay, I do believe that the reserve fund, of course, this is essentially for the benefit of the members. Okay. We have here members' contribution. Why is it that they only added 141 million in here? I think they only got the net. So we have your contributions coming in, and then you have your payment of benefits. They only provided the net amount here, and the addition to members' equity. Okay. Comprehensive income for the year of this. SSS share in ECC, corporate operating budget, withdrawal management costs, guaranteed income, annual incentive benefit, reclassification, accrual of penalty income, prior period adjustment, this recognition of allowance for impairment, valuation of reclassified, NCA. Then we have changes for 2019. Okay, so for 2019, this is the amount of increase in members' equity, but again, we'll see how they arrive at this figure later on. And then we have the cash flows. Okay, we see here now members' contribution 220 billion, investment and other income 15, payment to members 196, payment for operations 10 billion, not bad. But then if you look at this, the total of this is, okay, sorry, I would what do you call this? Say that this thing is losing. They have investment and other income, 15 million. And then I do believe that the operating expenses should be taken from the income and of course not from the members' contribution, right? So the payment for operations, 10 billion, is within their investment and other income. So that's good because it's not eating up the contribution itself. So net cash generated by operating activities, 28 billion. Cash flows from investing activities, so you have your loans, 20 billion, acquisition of property, 484 million, acquisition of intangibles, 14 million. Net cash used in investing at 21 billion. Cash flows from financing, so we have corporate operating budget, 243 million, contribution, 159, withdrawal, 73, guaranteed income, 35 million, annual incentive, negative 1 million, contribution, 27. 27 million, wait. Employees compensation commission, why do they have, I'm sorry, this is peso fund equity contribution, okay. Net cash used in financing, decreased 95 million. So net increase in cash and cash equivalents, 6.9 billion. Effect of exchange rate, 32. Wait, is this in millions already? It's in pesos. So 32,000. Cash and cash equivalents at the beginning, 15 billion. At the end of the year, it's 22 billion. Alright. Okay, so we're now at the notes to financial statements. So again, general information, information about the SSS, how it's been created, and then the benefits being given to the members. Alright. So we've already tackled the law, so we're not going to go over this again. Okay, so they have these, the contributions and then the employees' contribution, SIF. What does SIF mean again? Okay. So this is the breakdown of the income. This part, this part is essentially the supplementary to the statement of financial position, and then this one is for the statement of financial performance. Okay, summary of accounting policies. Again, the accounting standards being applied in the preparation of their financial statement. Okay, compliance, basis of measurement, estimates and judgments, provisions, events after reporting period. And then the changes, there are certain changes that also occurs with regards to accounting standards. And then they have these, there's a lot, right? I think this would help in understanding the presentation or the figures that is being presented in the financial statements, because some of them could be using the cost model and then some could be under the fair value model. Okay, so they have, what's this? Useful life of assets, intangibles, impairments, revenue recognition, members' contribution, interest and penalty, dividend, expense, leases. Okay, so we have the breakdown of the cash and cash equivalents. Cash on hand, in the vault of the different SSS offices, cash in bank, and then we have the cash equivalents. Basically, cash equivalents are short-term investments that are easily convertible to cash. Okay. It increased, again, from previous year, from 15 billion to 22 billion. Financial assets, we have from 30 billion, it became 45 billion, and then 37 to 64. So essentially, the fund is growing from previous year, from 2018 to 2019. Okay, and then we have cost of financial assets, 32 to 46, non-current from 178 to 183, and then they also provided the breakdown of the financial assets that has been presented in the face of the financial statement. Okay, so if you'd like to know, government bonds, corporate notes, and then government notes. These are the breakdowns of those investments in bonds. Then we have financial assets at fair value through OCI, equity, government bonds, security notes, corporate bonds again, other investments, and then we have the receivables, loans and the receivable accounts, lease receivable, and then other receivables. Okay, so from 7.6 billion, it became 5.8. So I'm not sure if there's an improvement in their collection process. And then we have from 4.2 to 4.5. Other receivables, 3.2, 1.18. It's, yeah, I think they did have an improvement in their collection process. Interest receivable, the breakdown, so I have that, 4.5 billion. Then other details concerning the receivables, interest receivable. And then we have non-current receivables, loans and receivable accounts, lease, other receivables, and then we have your member loans, pension loans, housing loans, commercial industrial loans, program member assistance for development entrepreneurship, yeah, business loans, I think. Okay, then we have allowance for impairment amounting to 7 billion, so that's a lot of money again. Okay, then we have the interest rate for the previous year, 2019. So they have this. Per annum, member loans 3 to 10%. I think they are, lower than bank interest rates. Pension loans, housing loans, commercial loan to other GOCC, sales contract receivable. Okay, so they have other information on the individual types of loans. Okay, and then we have impairment loss. What do you call this? Breakdown of the impairment loss. So 25 billion movements. From the previous year, 26 billion, it became 25. So I think that's a good thing. 1 billion, at least 1 billion change. Inventories, it also decreased. So are they using, lower amounts of supplies? Inventories, office supplies, accountable forms, drugs and medicine, medical, dental, and lab supplies inventory. Then they have the allowance. Oh, okay. They have allowance for impairment for this year, 31 million. Non-current assets held for sale, NCA HFS. So we have this 892 million. Several additions, transfers, disposal, and impairment. Held for sale, so there are certain properties that they are selling to the highest bidder normally. Okay, currently, this is for December 2019. What's this? 2017 and 2018. Okay, then you have our information, and then these are the breakdown of the properties: land, building, acquired assets registered. Okay, it increased. Okay. Maybe they had more, what do you call it? Seized properties for sale. Okay, so you have your land, building, acquired assets registered, other current assets, prepaid rent, advances to contractors, prepaid insurance, other prepayment. Okay. Then they have the investment property, building, land, development costs. If you're interested in the details, you can just go over this information again. Alright, property and equipment, what they use for their operations: land improvement, buildings, leasehold improvements, right of use, assets, furniture, equipment, transportation, computer, hardware, others. And then you have your construction in progress. If they're building new offices, maybe. Intangible assets, there are no particular accounts provided for, what types of intangible assets do they have. Mostly computer software and licenses, okay, they provide. And then other and current assets, deposits, and other assets. Financial liabilities, current, accounts payable, accrued, lease liability, non-current, lease liability. Okay, you have your interagency payables to BIR, 81 million, withheld from employees' compensation because the SSS itself is non-taxable, tax exempt, sorry. Due to GSIS, 74 million. Due to PhilHealth, 7 million. Due to Pag-ibig, 5 million. It's a little funny, that the employees of SSS, being a government-owned and controlled corporation, they are members of the GSIS. Okay. And then the SSS is catering to the private sector. Trust liabilities, trust guarantee, customers' deposits, funds held in trust, officials, employees, borrowers, suppliers, creditors, provident fund, flexi fund, dividends, educational loan funds. Okay, so they have that. From officials and employees, deducted from their separation or retirement claims for the benefits received, but subsequently disallowed in audit. Oh, okay. Respectively, this is done to assure collection once the pending appeal in court or COA will result in an unfavorable decision and the disallowance has become final and executory. However, in the event that the Supreme Court decision should be in favor of SSS and its employees, the amount withheld from these retired employees will be returned in full. Okay, so they're just awaiting, what do you call it? Supreme Court decision. 462 million. That's still a lot. A lot of money. Deferred credits and earned income. So you have output tax and earned rental income, and earned income, and realized gain in government bonds. Provisions for retirement, leave benefits, retirement, and other provisions. 1 billion, huh? That's a lot. Other payables, current and current, 1 billion still. Okay, breakdown, member loans collection, and distributed collections. OFW collection, sales contract receivable, rental, real estate loans collection, employees housing loan program. Why? So these are collections for loan amortizations and contributions that have not yet been posted to individual members or borrowers, pending receipt of collecting agencies, employers' documents, and actual distribution of collections and payments whose nature are not indicated by the payers. Why do you not indicate? So this is very important, when you are paying for loans or contribution or any of the contributions due to, or any payments due to SSS, you have to be very specific on which account you are paying it for para hindi kayo mapapasama dito, di ba? Baka mamaya maka-incur pa kayo ng penalty because they thought you're not paying. So, or you may not be able to, what do you call this, avail of the benefits because their contributions are not yet posted. So it's also very important now when you make payments, you have to keep the receipts or the evidence of payment. All right. Equity, reserve fund, revaluation, members' equity, cumulative changes in fair value. I really take an issue with this negative 31 billion. The investments are in the negative. Okay, there are changes. The cumulative changes is in the negative. Over the years, you have investment reserve fund. Okay, long-term viability of the SSS. Right. Affected by changes in demographic factors, increase in life expectancy, aging of population, declining fertility level, delay in retirement, economic conditions, interest rates, inflation, salary wage increases. Taking into account the uncertainty of future events, the life of fund is projected. Recent actuarial evaluations have shown some improvements in the projected fund life, from the fund life lasting up to 2031. In the 2003 actuarial evaluation, it extended to 2042 in 2015. However, the SSS, like most defined benefit social security schemes, is faced with the reality of a less than ideal actuarial fund life and a considerable level of unfunded liabilities. There is unfunded liability when the reserve fund is lower than the liability. The difference between the present value of future benefits and the operating expenses and the present value of future contributions. Yes, okay. The summary of results for the original 2015 valuation and the updated 2015 valuation, which took into consideration the 1,000 additional pension allowance in 2017, are compared in the next table. Okay, 2042, right? In 2015 valuation. Okay, the implementation of the 1,000 additional pension benefit reduced the fund life by 10 years from 2042 to 2032 and caused the net revenue to be projected to become negative by 2022, way earlier than 2034, which was projected in the original 2015 valuation. We'll see. Okay, this is very important. So starting this year, I'm going to be monitoring the financial statement of these government agencies. I'm very concerned. Okay, the unfunded liability was computed 4.9 trillion. Wow. Okay, proper comparison. Performing. This update resulted in an unfunded liability of 3.67 trillion. Thus, the increase in pension benefit in 2017 effectively increased the unfunded liability by 1.28 trillion. It's a lot. Mandatory coverage of OFW, introduction of unemployment benefit, establishment of voluntary and mandatory provident funds, rationalized powers and duties of the SSC, enhanced investment capabilities. Increase in contribution. Okay. Salary credit. Yeah, we discussed this during the discussion of the law. And then this is what I mentioned as well earlier. The maternity leave is 105 days, regardless of whether it's natural birth or cesarean. So this also increased the benefits to be given out by the SSS. So yes, essentially it does affect their fund negatively. Okay, and then there's a leave for solo parents. The effect of the new two laws and updated is summarized on the table below. Year fund will last 2032. Year net revenue becomes negative in 2022. We will see in 2022 if this is true. Liability 5.38. Is this what's this percentage? Reserve fund 0.43 and funded fund 4.95. Okay. The implementation extended the fund life by 12 years and projected net revenue to turn negative by 2037, much later than the 2030, which was previously projected. Oh, okay. So currently, there is the implementation of RA 11199 and RA 210, the increase in contribution as well as the other benefits that has been this part here. So in 2019, this report here, extended the fund life by 12 years. So it's now from 2032 to 2044. And then the expected net revenue will turn negative by 2037. Okay, so it's been extended, so we're probably not going to see it in 2022, which was the previous projection. Okay. Prior to the passage of these laws, the unfunded liability was 4.95 billion. Okay. Adjusting the reference date, the unfunded liability increased to 5.56. However, considering the effect of the new laws, the unfunded liability was reduced to 4.72 trillion. Okay, so we have this final figure as of the moment. Okay, we'll see any changes in the 2020 audited assets. Alright. Determined using an open group projection method where members who will join the system in the future are considered in the projection of revenues and expenditures. Okay. The signs such as the contributions of the current paying members fund the benefits of the current pensioners. This is the sad thing about this. Hence, there is income transfer across generations. With the continuous membership of future generations into the system, the benefits of the current and future pensioners are continuously funded by the contributions of the former. Hence, the open group projection method is appropriate in assessing the sustainability of the SSS program. As long as what's coming in is higher than what's going out, then it's really going to be sustainable in that regard. But the moment what's coming in is lower than what's going out, then that's going to be problematic and alarming. Alright, the closed group, which is not being used anyway, so let's not discuss that. Okay. But they did the comparison, they provided the information just, to justify the use of the open group. essentially in the closed group. Okay, I think what I wanted was a closed group, but then it would not be viable or sustainable in the long run. But still, it's actually what's ideal. Considers only the existing members up to the end of the reporting date while continuing their contribution up to a certain date. The unfunded liability computed with this approach is highly theoretical, yes, in a way, as it is only truly meaningful for a program that is intended to be fully funded. Nevertheless, it provides an insight as to the magnitude of the unfunded liability of a program that is designed to be partially funded, such as the SSS program. The comparison of the unfunded liabilities computed under the open and closed group projection methods are presented. Okay. If it's an open group, if it's a closed group, fund will last 2044, sa closed 2036. Year net revenue becomes negative 2037, 2030. Unfunded liability computation, discount rate 6%, liability 5.48, I think this is trillion, right? 6.85 higher, reserves 0.48, the same, unfunded liability 5 trillion, 607 trillion. Okay, the SSF life under the closed group method is short by 8 years compared to, and the unfunded liability in under the closed group is greater. All right, we have that. Okay, during the period from 1980 to 2016, pensions were increased through across-the-board pension increases up to 20%. And increases in minimum pension amount through the following RAs was also increased 12 times. The contribution rate, on the other hand, was only increased 4 times during the same period, from 8% to 8.4% in 1980, 8.4% to 9.4% in 2003, and then to 10.4% in 2007, and finally to 11% in 2014. The effect of demographic change in the fund should also be recognized, as they may not be enough contributors remitting to pay all the expenses and benefits of the growing number of pensioners due to the declining population growth rate and lengthening lifespan. Alright. Actuarial evaluations and other studies are conducted regularly, the results of which serve as basis of recommendations for policy reforms. Okay. Revisiting the pension formula, raising the contribution rate, improving the contribution collection, increasing the minimum and maximum monthly salary credit, revisiting the pension formula, reviewing the qualifications for eligibility for long-term benefit, raising the retirement age, exploring other means to improve the adequacy of benefits. I would be against this one. Sorry. I do understand that lowering the retirement age would be detrimental to the fund, but raising the retirement age, this would really be, what do you call this? There's going to be a lot of complaints from the members, who are looking forward to retiring. Seriously. Further reform packages and other measures shall be formulated, which simultaneously address the interests of the stakeholders of SSS, benefit adequacy for current pensioners, and financial sustainability for future pensioners who are now active contributors of the SSS. So we have the revaluation surplus, members' equity. Oh, okay. So this only represents the contributions of Flexi Fund and Peso Fund members, which earn interest based on guaranteed rates. Okay. So it's not really the contribution. So I think the contribution goes to the reserve fund. Service and business income, contribution 219, interest income 20 billion, fines and penalties 3 billion, dividend income 2.9 billion. Okay. Interest income breakdown, and then the gains, their breakdown. Changes in fair value of investment property, financial instruments, transfer, sale, redemption of investment, gain on forex, gain on sale of property. Okay. Other non-operating income, reversal of impairment loss 1.5 billion. Miscellaneous income 419. Benefit payments, so we have retirement, death, maternity, wow, 57, 10 billion, disability 7 billion, funeral grant 4, sickness 3, unemployment 177 million, medical 10. It's a lot. Okay, personnel services 6 billion, salaries, other compensation, personal benefit contributions, other personal benefits, maintenance. Okay. their expenses and their operations. And then they have financial expenses, interest expense on lease liability, bank charges, other financial charges. Non-cash expenses, so they have their loss, depreciation, impairment, and amortization, 5.3 billion. Assistance and subsidy, so they have this educational assistance loan program, funded 50-50, government and then SSS. Okay, so they have this history of how much they have been provided. Why is there no 2019 here? Okay. List commitments, alright, related party disclosures, mostly the SSC, Social Security Commission, their remuneration. Okay, 70 million for these people. Financial risk management, because they're a fund, how they are dealing with their different types of risk. Okay. Then they use stockbrokers because they are doing investments. Restatement, correction of, since they're correcting the application of accounting standards, there would be restatements on certain items. Effect on statements, events after reporting period. Okay. Remittances, other matters, compliance with tax laws, types of taxes that they're paying, on compensation, expanded VAT, final tax and output tax. Okay, and then they have the status of lawsuits and the claims. Alright. So, alright, we've discussed the financial statements, complete the phase as well as the notes. Let's just see the current, 2020. So, as of September 30, 2020, current assets, 110. They did increase, right? From 93 to 110, from 22 to 43. But of course, this is only September, so there's still a 3-month gap. But still, it's higher, than December. Sorry about that. These are probably going to be spent for the benefit payments from October to December still. So these are probably going to go low at December 31, 2020. Anyway, essentially, it's higher as of these dates. Liabilities from 10 to 21, from 12 to 23, and then the reserves from 555 to 578. Okay, the equity. Okay, income from 182 to 175. Okay, but the total is almost the same at 186 billion. Expenses, benefit payments, 146 for the 1 year in 2019, and then 2020, this is only 9 months, 141 already. Alright, they have that, and then profit 31 to 28. Comprehensive income from 37 to 23. But essentially, there are a lot of benefits that have been added during 2020. So, there are unemployment benefits, and then there are also claims for sickness. Okay. Cash flows, we have that. The cash did increase, but this might change still. Okay, so I think I'm going to stop here because essentially the content of the annual report that they have for 2018 is, majority of this is the financial statements for 2018, but since we already discussed the latest, which is 2019, so that should be enough, I guess. Okay, but if you want to read, they have this highlight information, increase in contributions, 13.9. New covered members, there are additional 1.65 million. Okay, 332 additional offices, 2.5 pensioners, 3.7 individual benefit claims. So yeah, they have this highlighted information. So if you want to read this, you can also download this from their website. Okay, I will be providing the links in the description of the video so you can also access them. Alright, so that's it for this video. Thank you and bye.